MDA Space, a strong business at a demanding price. May 2026. What MDA Space actually does. MDA Space, TSX, MDA, NYSE, MDA, is a 55-year-old Canadian aerospace company that builds satellites, space robotics, and Earth observation systems. It is not a startup. It generates real revenue, real profits, and has a large order backlog of contractually committed work. In Q1 2026, MDA reported 464 million Canadian dollars in revenue, up 32% year-over-year, and carries a backlog of 3.69 billion Canadian dollars in future contracted work. 1. Those are genuinely strong numbers. The question for any investor is not whether the business is good. It is whether the stock is priced fairly given what the business is likely to deliver. Why demand for satellites is growing, and why it's not just hype. To understand MDA's growth, you need to understand a structural shift happening in the satellite industry. For decades, most commercial satellites sat in geostationary orbit, GEO, roughly 36,000 kilometers above Earth. At that distance, the round-trip signal delay is 500 to 600 milliseconds. That lag is barely noticeable for TV broadcasts, but it makes satellite internet nearly useless for modern applications like video calls, cloud services, or financial transactions. The industry is now building low Earth orbit, LEO, constellations instead, networks of hundreds or thousands of small satellites orbiting just 300 to 1,200 kilometers above Earth. The shorter distance cuts signal delay to 20 to 40 milliseconds, comparable to a standard home broadband connection. This shift creates a structural manufacturing demand worth understanding clearly. GEO satellites are large, expensive, and designed to last 15 to 20 years. Once you launch one, demand from that customer largely disappears for a decade. LEO satellites are smaller and cheaper per unit, but they orbit low enough to experience atmospheric drag. They have a functional lifespan of roughly 3 to 5 years before they naturally degrade and burn up on re-entry. 2. This means any operator running a LEO constellation must continuously order replacement satellites just to maintain their network. For a manufacturer like MDA, this creates recurring demand rather than a one-time project. This is a legitimate structural argument. It is not hype. The replacement cycle is real and gives MDA more revenue visibility than a traditional defense manufacturer. What MDA is building toward. MDA has several meaningful growth initiatives underway. The Montreal manufacturing expansion on May 8, 2026, MDA officially inaugurated a new 185,000 square foot facility in Montreal, doubling its total factory floor space. 17. The plant uses automation and augmented reality assembly tools to build satellites at scale, up to 400 per year. 3. Near-term production is committed to 2 specific contracts, 198 satellites for Telesat Lightspeed and 50-plus satellites for Globalstar's direct-to-device network. 4. One point worth clarifying for retail investors: these Telesat and Globalstar contracts are already counted inside the existing $3.69 billion backlog. 1. The new factory is the tool MDA is using to execute work already booked, not a signal that a fresh wave of unannounced contracts is imminent. The facility expands production capacity, the backlog is what fills it. MDA Chorus, shifting from hardware to data. MDA is building its own Earth observation constellation called Chorus. Unlike its satellite manufacturing business, where MDA builds hardware for other operators, Chorus will be owned and operated by MDA itself. The plan is to sell recurring data services, weather-independent radar imagery, maritime tracking, and national security intelligence. 5. This is a higher-margin business model than hardware manufacturing, because once the satellites are in orbit, each additional data customer adds revenue without adding much cost. MDA has secured 41 early commitments, comprising 9 finalized contracts and 32 letters of interest. 6. Important caveat: letters of interest are not signed contracts. They signal commercial interest but do not guarantee future revenue. Investors should weight the 9 signed contracts more heavily than the 32 letters of interest when evaluating Chorus momentum. 49 North, a dedicated defense subsidiary. In February 2026, MDA launched 49 North, a wholly owned subsidiary focused on Canadian defense contracts, specifically secure communications and intelligence systems for land, air, and marine operations. 7. Canada's updated defense industrial strategy has earmarked roughly $180 billion in procurement spending, with a mandate to prioritize domestic prime contractors. 7. 8. By operating a dedicated, Canadian-based defense entity, MDA is structurally positioned to capture long-term government contracts that foreign competitors cannot easily access. Chip manufacturing via SpaceX FY acquisition. MDA acquired SpaceX FY Communications, giving it the ability to design and manufacture its own space-grade semiconductor chips in-house. 9. This matters because chips are among the most expensive components in a satellite. Making them internally reduces costs and protects margins as production scales up. U.S. IPO and debt paydown. MDA completed a U.S. IPO on the NYSE in March 2026, raising approximately $341 million in gross proceeds. 10. Management directed a significant portion toward paying down revolving credit facilities. 10. 11. Lower debt means lower interest payments, which means more of the company's operating profit flows through to net income and earnings per share. The valuation, where things get complicated. Here is the honest picture on valuation, separated into what we know and what we are being asked to believe. What the numbers say today. MDA's trailing P/E ratio, based on the past 12 months of actual earnings, is approximately 74x, 12. The North American aerospace and defense industry average sits around 34, 36x, 13. MDA trades at roughly double its sector average. A 74x P/E is high by any conventional standard. For context, you are paying $74 for every $1 of earnings MDA generated over the past year. The bull argument: earnings will grow into the valuation. Supporters of MDA's current price argue that the 74x trailing multiple is misleading because it reflects the past, not the future. The Montreal factory is now operational. Chorus is approaching launch. 49 North is ramping. Earnings should accelerate significantly. Analyst consensus estimates project the following EPS growth: 14. Year. Consensus EPS estimate. Implied forward P/E. 2026. 0 Canadian dollars and 83 cents. 71.7x. 2027. 1 Canadian dollar and 1 cent. 59.0x. 2028. 1 Canadian dollar and 19 cents. 50.2x. If these estimates are correct, MDA's P/E compresses to 50x by 2028, not because the stock falls, but because earnings grow into it. That is the bull case. 2 problems with this reasoning. Problem 1, 50x is still very high for an industrial manufacturer. Even if MDA hits every earnings target perfectly, a 50x forward P/E in 2028 sits nearly 40% above the industry average. 13. Software companies can sometimes justify 50x multiples because they can serve additional customers with almost no extra cost. MDA cannot do that. Every additional satellite it builds requires physical materials, specialized labor, and expensive factory infrastructure. Its margins have a natural ceiling that software does not. The Chorus data business does carry software-like economics once satellites are in orbit, but that segment will represent a minority of total revenue through 2028. The bulk of MDA's business remains industrial manufacturing. 1. For context, consider Micron Technology, $mu. Micron is currently growing earnings at over 70% annually, driven by surging demand for high-bandwidth memory, HBM, used in AI data centers, a durable, infrastructure-level demand signal. Despite that growth rate, Micron trades at a forward P/E of approximately 12x, 16. MDA, growing earnings at roughly 16% annually, trades at 50x forward. Readers should weigh what that disparity implies about the premium being assigned to MDA's defense backlog and revenue predictability, and whether that premium is proportionate. Problem 2, multiple compression assumes the market holds its current opinion of MDA. Even if earnings grow exactly as projected, the stock could still underperform if the market re-rates MDA from a high-growth tech multiple back toward a standard industrial multiple. This is called multiple derating, and it is a genuine risk at any elevated valuation. Consider the math using the 2028 consensus EPS estimate of $1.19, 14. Scenario. Multiple applied. Implied stock price, CAD. Market maintains premium. 50x. $59.50 CAD. Market re-rates to sector average. 35x. $41.65 CAD. That is roughly a 30% gap in outcome driven entirely by investor sentiment, not by anything MDA did or failed to do operationally. This is the most underappreciated risk in the bull thesis. The SpaceX wildcard. On May 20, 2026, SpaceX filed its S-1 prospectus with the SEC, targeting a Nasdaq listing under the ticker SPCX at a valuation between $1.75 and $2 trillion, 15. This matters for MDA investors in two specific ways. The risk: for years, institutional investors wanting public equity exposure to the space economy had limited options. MDA was one of the few liquid, profitable choices, a scarcity that helped support its premium valuation. SpaceX's public listing dissolves that scarcity. Fund managers may rotate capital previously allocated to MDA into SpaceX, removing a structural prop from MDA's multiple, 15. The partial offset, SpaceX's S-1 revealed that despite $18.67 billion in full-year 2025 consolidated revenue, the company posted a GAAP net loss of $4.94 billion for the year, with losses accelerating sharply to $4.27 billion in Q1 2026 alone, driven by massive AI infrastructure spending, 15, 16. Against that backdrop, MDA, with its contracted backlog, positive net income, and debt-reduced balance sheet, looks financially disciplined by comparison, 1-10. This may limit how much valuation pressure MDA faces among investors focused on profitability metrics. One important clarification: SpaceX is not a direct competitor to MDA. SpaceX operates in rocket launches and consumer broadband. When MDA builds a satellite constellation for a client, those satellites typically ride into orbit on SpaceX rockets. 4. The two companies are more complementary than competitive. MDA's real competitive advantages. Despite the valuation concerns, MDA has genuine structural advantages that justify some premium over a generic manufacturer. Switching costs are high. MDA is currently engineering Canadarm3 for NASA's Lunar Gateway program, 1-8. The software, mechanical interfaces, and docking architecture are all being custom-built around MDA's robotics ecosystem. For NASA or the Canadian Space Agency to switch to a competitor at this stage would require rewriting billions of dollars of mission-critical software and delaying international launch schedules by years. That is a real and durable moat. In-house chip manufacturing. Through its SpaceX acquisition, MDA designs and fabricates its own space-grade semiconductors. 9. This eliminates dependency on external suppliers for one of the most expensive satellite components, protecting gross margins as production volume scales. 55 years of cleared relationships. Winning government and defense contracts requires security clearances, regulatory trust, and a long track record of reliable delivery. New entrants cannot replicate this quickly by lowering prices. MDA has operated alongside the world's leading space programs since 1969. 8. The competitive landscape. MDA's actual competitors are not SpaceX. They fall into two groups. American new space companies, York Space Systems, Rocket Lab, and Lockheed Martin compete for satellite manufacturing contracts in the same categories as MDA. 4. 8. In orbital robotics, Maxar Technologies and Redwire Space are pursuing NASA hardware contracts for lunar exploration programs. European consolidated bloc, Airbus Defence and Space, Thales Alenia Space, and Leonardo have systematically merged satellite manufacturing capabilities into a jointly integrated competitor. 9. This European consortium represents MDA's toughest rival when bidding on large commercial telecom constellation contracts outside the defense sector. How to think about the backlog. The 3.69 billion Canadian dollars backlog is contractually committed work, not a pipeline estimate. 1. At MDA's guided annual revenue run rate of approximately $1.7 to $1.9 billion CAD, the backlog represents roughly 2 full years of committed production with zero speculative inventory. 1. Beyond that, MDA's longer duration defense and robotics programs, particularly Canadarm3 and related planetary exploration contracts, extend meaningful revenue visibility into the 2030s. 1. 8. MDA also reports a 40 billion Canadian dollars opportunity pipeline. 7. This figure represents potential future bids the company is tracking, not contracted work. It is a useful indicator of addressable market size, but investors should not treat it as committed revenue. Conclusion: good business, demanding price. MDA Space is a genuinely strong industrial business operating in a sector with real, durable demand drivers. The LEO replacement cycle is structurally sound. The backlog is real and contractually locked. The moat, built on switching costs, in-house semiconductor IP, and long-established regulatory relationships, is defensible against most new entrants. But the valuation asks a lot. At 74x trailing earnings, 12, the stock is priced for near-perfect execution. The path to multiple compression relies on 3 simultaneous conditions: earnings growing as projected, the market maintaining its current enthusiasm for space sector names, and no meaningful execution disruption. If all 3 hold, MDA could be fairly valued or even modestly undervalued by 2028. If any of them slip, a contract delay, a margin miss, or a broader sentiment rotation away from high-multiple industrial names, the downside is material, because today's premium leaves little cushion. The honest summary: if earnings reach $1.19 by 2028 and the market sustains a 50x multiple, investors likely earn modest returns from current levels. 14. If the market eventually re-rates MDA toward a standard industrial multiple, 35x, significant downside is possible even with solid operational delivery. 13. The SpaceX IPO introduces a new capital reallocation dynamic that could pressure MDA's multiple independent of its own execution. 15. MDA is not a bad company. At the current price, it may not be a bargain. This analysis is based on publicly available information as of May 2026. It is not financial advice. All figures in CAD unless otherwise noted. Do your own research before making investment decisions. Subscribe for updates. References.